in your thinking the potential impact of a well-functioning capital market on your country. The sources of revenue and new businesses and investment opportunities and wealth creation that it can bring, not just for investors to make money, which is my primary interest on a day-to-day basis, but it's also for the good of the country and the society. A healthy, well-functioning, disciplined, excellent capital market is an absolutely critical part of a growing, vibrant, independent economy. And that's clearly the vision that I've heard communicated to me as we've been talking about capital markets. On a day-to-day basis now, I am a professional investor. I was at an investment bank before. Now I'm at Alkion Capital. My areas of expertise are in alternative energy, solar, wind, utility companies, gas companies, power generation, infrastructure. So I spend a lot of time with engineering construction companies, a lot of time discussing new nuclear plants and other big infrastructure projects with the companies that we invest in. And I also look at some of the more traditional cyclical industries which are important here, such as, which we would qualify as cyclical or commodity cyclical, agriculture businesses, coffee, tea, some of your specialty metals businesses are all very interesting things that I think you'll see as your capital markets open up. You will see a lot of foreign direct investment in a lot of these businesses. Capital markets law. Why did I put that up? Because the publishing of the law, I think, is next week or in the next couple of weeks. And at that point, you'll begin to see some opportunities unfold with public stocks being offered, additional bonds being offered, and some real opportunities for investors to invest, which then starts the capital creation process, because that money goes directly back into the economy. That's the vehicle by which jobs are created, and you'll start to see quite a bit more prosperity. We're going to spend a second on long-term global trends. We'll talk about the turbulence of the last couple of years. When I say turbulence, I mean the global markets that had significant difficulties with the failure of Lehman Brothers and some other investment banks. And I think one of the practical impacts of that was that the construction business in Rwanda went from growing 40 or 45% year over year in 2008, half what it was in 2008. The world is a very small place from a capital market standpoint, so it's worthwhile to understand what caused the recent turbulence and what the long-term impact of that is. Then we'll talk about emerging markets in general. Emerging markets perform better, that's why investors seek them out, and Rwanda can certainly be in that situation. And then the last thing we'll talk about is the opportunity specifically to Rwanda and some of the early IPOs that you'll be having. The most important thing when you're looking at long-term capital financial trends is what's the interest rate environment. The interest rate tells you an awful lot about the economy, and it tells you a lot about the potential for growth in the economy, the stability of the economy. For a very long period of time now, the 10-year Treasury bond in the U.S. has become the benchmark interest rate and in place for 20 to 25 years in global capital markets. And that is a super cycle in bond prices. Essentially, short rates in the U.S. went from close to 20% in the late 70s and the first part of the 1980s to rates that are around 2% for a 5-year right now, 2.5% as you can see for a 10-year. The interest rates, as I understand them in Rwanda, are something more on the order of 9% for the 2-year, the most recent bond auction that the government did, probably over. So as you think about what's going to happen in the capital markets, I think we're going to be more in a period of time where interest rates are tending to rise than fall. And the reason for that is, ultimately, when credit is very cheap, you tend to have a lot of credit issued, and people borrowing a lot of money and a lot of leverage. And there's a lot of money in the system, particularly that's put in the last couple of years, that ultimately has a good chance of fueling inflation, which will drive rates higher. So these things tend to be cyclical, but the long-term trend of falling U.S. interest rates and the impact that that's had on the global capital markets is very close to reversing. If any of you have gold stashed at your home, and you probably wouldn't tell the crowd because it has become very popular, but it has become very popular for global investors to buy gold. I tend to like to do things interactively, so I'm going to give this 1 or 2 shots. If it doesn't work, I'll stop. But does anybody have a guess as to why everybody is buying gold as fast as they possibly can? Less risky. That the central bankers in the United States and Europe in particular aren't sure what they're doing and trade. And so when you see gold prices doing what they're doing, it is telling you 2 things. Number one, we don't trust central banks. And it's interesting to me that Rwanda's central bank rate's been coming down, which tells me that people are actually more comfortable with the central bank and the central banking system and the banking system as a whole in Rwanda recently, and that will probably continue. And the exact opposite trend is now happening in the West, where people think that the US and the Eurozone have too much debt, they're trying to spend too much money to keep the economies growing, as opposed to doing more sensible things, in which case you would see gold not doing this. The second item that you usually expect when you see gold doing this is inflation. It's very difficult to forecast when inflation will pick up. Inflation is very low in the US right now. It's running between 1% and 2% per year. Because inflation hurts people who save money. And so rather than saving money, dollars, people have decided that I want to save gold because we're going to start to see some inflation. George Soros, who's a very famous global investor, said, I think gold is a bubble, but it's often rational to invest at the beginning of a bubble. Meaning he doesn't know, and nobody else is really sure, when the central banks around the world will get things under control. I think the lesson for Rwanda, in particular, is to stick to the vision that you set. You can take advice and listen to people from the West, but we're not sure what we're doing, okay? So if you have a strategy and it's working, you should stick to it at all costs, because it will be as effective as anything that some of the developed markets have actually accomplished. I wanted to spend a little bit of time on the turbulence of the past couple of years. It affected all the global financial markets. Again, you would think that individual countries would not be affected by the contagion, but there was virtually no economy untouched. It was, there were relative effects, but every economy has been affected by what's happened in the global financial markets. That is the S&P 500 index. It starts in 2006. Oh, sorry. I'm going to turn off. In aggregate, how stocks are doing in the U.S. In 2006, the market was doing quite well. It hit a peak in July of 2007, which was right here, low down. Prices stopped going up. This was the first time U.S. house prices had not gone up in essentially recorded history, but probably for a couple hundred years since the Civil War. Why is that even relevant? It's relevant because people use their houses as a way to get more debt. So if you think that the value of an asset you have is going to go up in value from now and forever, you can actually continue to just get more debt on it, and you never really have an issue because you continue to refinance the debt on that particular asset. Well, that Ponzi scheme, as it were, came to an end in 2007, and once house prices started to go down, we started to see some shocks in the financial markets and in stocks specifically. Why is that relevant to Rwanda if U.S. house prices in Florida, in Miami, in Las Vegas, in Riverside, California start to go down? The reason is that the value of U.S. housing stock is $13 trillion. Something back.